This one will get lots afterwards. At the right. Truly, yes. 3 hours behind. Oh, so that's good for them. Well, ladies and gentlemen, once again, welcome to this very special segment. And today's a very special segment. We are invited and excited to invite you to join this insightful presentation which we're going to have. You'll be the first to know which Brisbane, Melbourne, Sydney and Hobart suburbs have made it to the cut with the PRD's affordable and livable property guides for first half of 2021. In the report today, we will be discussing property market, how it has fared in the first half of 2021 with the multitude of shocks which the COVID-19, financial markets, bilateral trade issues, and levers, grants, new policies, and low interest rates. With the federal budget released, what can we expect from the property market in the rest of 2021? And today we'll be joined, and you have the opportunity for a Q&A. If you so wish, you can put in your questions in the comment section of our Facebook live session. So joining us here in the studio is Dr. Swati Madismo, or the PRD Chief Economist. So once again, Asti, welcome to the show.
Thank you so much, Umesh. Thank you so much for having me. It's always great to be here and to be sharing all of these insights and knowledge, and particularly the suburbs, with your listeners.
And it is wonderful that you could once again join us, and it's all been great. So what's been happening, and so what has the research found so far?
Look, the Australian property market as a whole, we hear it in the news a lot. We hear it in a lot of the channels saying that the property market is really hot at the moment. The property market, there's a lot of people buying, there's a lot of demand in the property market. And that is absolutely true, Umesh. The Australian consumer confidence at the moment is above 100 index points, which is above the positive sentiment. And when you do have that, when you do have that level of confidence in the society, it means that they are confident in the economy. They feel that they're being looked after. They feel that everything is going to be okay, and they want to spend their money. They've had some very pent-up demand because they couldn't go on an overseas holiday. They couldn't go to visit their family internationally. They haven't bought any big ticket items. They were able to save throughout COVID because they didn't go out to restaurants as much or go out to outings as much. And the current market at the moment has that pent-up demand, and it is helped by such a low interest rate. We are seeing the lowest home loan mortgage rates at the moment. A lot of people are fixing their mortgage rates to only 1.98% over the next 2 or 3 years. And for someone who has, say, a $300,000 mortgage, that's literally a saving of about $300 to $400 per month. And because of that, people are feeling that they have more money. They want to either upsize, or they want to buy a second investment property, or they want to make use of all of the government grants that is available to them, whether they're a first home buyer and they might be able to access home builder, or the current new one, the scheme for single parents, where single parents can actually access the property market with as little as 2% deposit. And many people thought that this is just for first home buyers. It's not. It's also for people who have owned a property previously. So that really opens up the market, in terms of more incoming demand in the next few months.
Okay, so looking at that incoming demand as you have talked about, and of course the property market is still being quite buoyant. And when we talk to agents, where that's a different report when they talk about what's happening in their suburbs. But of course everyone bases the things on the research that you have done. So on a national basis, so let's first of all let's take a look at the broader outlook first. Throughout the nations, how have the capitals fared?
Look, the capital cities have fared really, really well. Now, I'm just going to put a disclaimer that the figures and the research that we've done was prior to the Melbourne lockdowns. I know that some people will ask me, well, how is that going to impact the Melbourne market? And look, to be honest with you, the Melbourne market actually grew by 2.4% from the first quarter in 2020, which is pre-COVID, versus the first quarter 2021, which is basically the quarter that we've just had before their lockdowns. So all throughout that time, pre-COVID and post-COVID, some might say, before the lockdowns, they actually held quite resilient. Their median price stayed at about $1 million, 2.4% growth. Sydney also grew. We all know that Sydney is the most expensive capital city. Their median price at the moment have hit 1.7 million, whereas Brisbane and Hobart is staying to be the most affordable capital city when it just comes to median price. So the Brisbane Metro capital city median house price is $725, whereas the Hobart one is about $550. And so, we are definitely seeing that if you're just looking at it from a dollar perspective, yes, there is Sydney is the most expensive capital city, followed by Melbourne, followed by Brisbane, followed by Hobart. The one thing that we need to remember, though, is that all of the capital cities have had all of their differences when it comes to COVID. Some of us have had more restrictions than others. Some have had a more open economy than others. But overall, as a general trend, the property market across all capital cities have grown throughout COVID. We've in Brisbane, we've seen double-digit growth, 11 or so percent over the past, year or so. And so regardless of where we are around Australia, around any of the different capital cities, we are definitely seeing a strong, resilient property market even throughout the shocks of COVID.
So, that is wonderful to see that, even through this COVID, we have seen very strong markets and double-digit growth, as you talked about right here in Brisbane itself. And that is a good observation that you made, that it was the report was pre the lockdown, which has just happened. And when we look at the capital cities and the weekly graphs and everything that's been put out, if you look at auction results, and it is quite obvious of what's happening in Victoria, and of course what you mentioned about Sydney and being one of the most expensive ones. So moving forward, outlook, looking at some of the suburbs here in Brisbane. So how have that suburb fared?
Look, I am actually very, very excited about Brisbane. The reason being is I think I came on the show last year to release to everyone where are the affordable and livable suburbs in Brisbane, and most of the suburbs were in the north side of Brisbane, whereas this time around we were able to find affordable and livable suburbs all throughout of Brisbane. And that's very exciting for us because it means that it's not just concentrated on one pocket of the city. It opens up the possibility for anyone who is living anywhere across Brisbane to actually access these suburbs. Now, I will explain again in the sense that you look at the prices in these suburbs and it may not be the cheapest suburbs from a dollar perspective. However, these are the suburbs that are the most affordable, that are the best value if you want a suburb that is within 20 kilometers from the CBD. So it's not going to take you 2 hours to go to work. It's within 20 kilometers from the CBD. There's positive capital growth. So it's an area that is growing. There's infrastructure and commercial projects entering the area in the next 6 and 12 months, which means that it's going to keep on growing. And if anyone is an investor, these are places that we have secured, or we have counted their what we call investability. So we want to make sure that it has a higher rental yield compared to the capital city, and we also want to make sure that it has a lower vacancy rate than the capital city. So for those of you who may not know what that means, higher rental yield means that you're getting more bang for your buck in terms of rental income, and if you have a lower vacancy rate, it means that the chances of your properties being occupied quickly is much higher. So as an investor, you want that quicker cash flow coming through. So we've made sure that these suburbs can deliver when it comes to investability. And the most important part is livability. Throughout COVID, we have learned that having or living in a livable suburb is very important. With this one, we've made sure in terms of livability that there is low crime rate. So it's a safe place to live. It's a place where within 5 kilometers you can access hospital, supermarkets, restaurants, green spaces like parks and kids playgrounds, medical, so like doctors and GPs and pharmacies and things like that. I remember one time, if you remember, Umesh, one of the lockdowns was that we could only travel like 5 kilometers or 10 kilometers from our suburb. And so, we wanted to make sure that if we were ever in that situation again, that you are choosing a suburb that can deliver all of that. And also we've chosen suburbs that have a low unemployment rate compared to the Queensland or the other state averages. So that means that there is that local jobs. So, those are the criterias for the suburbs. So it may not be the cheapest from a dollar perspective, but if you want to tick all of those boxes, these are the suburbs that will be the most affordable to you.
And I think that's a very good point that you've made there, that it's not just the dollar value. There's so many other things to consider. So all the investors who are listening there, that it is very, very important that you look at all those things there, and combined, to put all those things together in the report, in that research, is what gives that affordability and the livability that you have also mentioned. And some of the very key points that you made there is access to hotel, access to hospitals, access to the coffee shops. That's becoming very common these days. You need to have your coffee, and of course all the services and low crime rate, which you've mentioned. So all these things put together, often people who are not very experienced in property market, and they're just going by, they'll probably more so just look at the dollar value and not look at all of those things. And so when you're looking at the capital growth in the end, it will be all these things. It will be dependent upon all of these things. So it's not just the dollar value which you have just mentioned. Very quickly you have touched on the rental returns and on the yield. So how has the rental yields and the rental demand being comparing houses suburbs to the inner city apartments?
Look, in terms of the rental market, I'm going to be the first to admit that there is a rental crisis in a lot of the capital cities. And when I say a rental crisis, I mean that there is a high amount of rental demand and not enough rental supply. So in a lot of the capital cities, the vacancy rates are actually dropping down really low. Right. Brisbane at the moment is at 1.5%. And this is basically half of where we were 2 years ago. 2 years ago, we were at 3.8%, which is higher than the Real Estate Institute of Australia's healthy benchmark for the balance of rental demand and rental supply. There was more supply back then.
Yes.
So if you can think about it from the perspective of we've gone up from here 3.8 and we've dropped down to 1.5, that's actually quite significant. In places like Hobart, we're at 0.4% vacancy rate, which literally means there's almost no rental supply in the area. Melbourne and Sydney are a little bit higher at 4.4% for Melbourne and 3.3% for Sydney. They've always been trending at a more higher rate. A lot of it does have to do with the lockdowns that Sydney and Melbourne has experienced, and also that in those capital cities like Melbourne and Sydney, there's definitely more units than houses in the capital city. Whereas for us, we're still actually seeing quite a bit of houses in the inner ring of the CBD. Like, in the city, yes, you might be seeing a lot of units, but you go to Spring Hill, you go to West End, you go to Highgate Hill, you're seeing houses. And the same thing in Hobart, you're seeing a lot of houses in the capital or the inner ring as well. So the house market is definitely, for rentals anyway, it's definitely the driving force in terms of people wanting to rent houses, people wanting to move away from the capital city as well and looking for a house because of the work from home sort of trend. So there's definitely been a shortage in the rental supply in the market. So one of the things that is very much so that I always like to say is, if you are an investor, monitor the vacancy rates. And if you start seeing the vacancy rates go down, it means that rental supply is starting to go down and that there is a higher rental demand. And that's when you actually want to enter the market.
And that is quite a good observation there. Now, Asti, when we look at all of this, once when we entered COVID period, there were all this doom and gloom, all the talks about everything's going to happen, property is going to crash, the rent moratorium that was introduced and everything like that. We'll have vacant properties, we'll have tenants sitting in properties who will refuse to pay rents, and landlords, it was all this doom and gloom. And of course, we have had a negative immigration. So what is driving the market? Where is this demand coming from?
Look, Umesh, you're definitely right. I remember those times where people thought that the capital city markets is going to drop, people's going to lose about 20-25% of the value of the property market, things like that. So yes, there was all of that doom and gloom, right? However, both the fiscal policy, so that's the government, and the monetary policy, that's the Reserve Bank of Australia, they've both, this time around, really worked together to create a market that has insulated us a little bit. So the RBA, for example, they cut the cash rate about 4 times since the beginning of COVID to allow people more credit, to make it cheaper for people to get credit so that they can either get credit to do business, to keep their business floating, or to access the property market. And for those landlords, they're able to reduce their mortgage payments on a month-by-month basis. So the RBA had a hand in that. The federal government also had a hand in that. JobKeeper came on, JobSeeker came on, in terms of all of the stimulus payments. Home Builder came on. There was a rental moratorium, and all the banks came on board by saying that you can freeze your mortgage for 6 months and then we can review it and we can work on you by a case-by-case basis. So at the beginning, there was a lot of doom and gloom because people didn't know anything. People didn't know what was going to happen. And people didn't know how long the COVID was going to last. We still don't know right now. Things can still happen, but before you know it, nobody expected the Melbourne lockdown. There's actually a big real estate conference in the Gold Coast this weekend, and a lot of the Melbourne agents are literally scrambling to try and sell their tickets because nobody expected it. But because there was that unknown, everyone pulled in. The banks pulled in, the Reserve Bank of Australia pulled in, the fiscal policy, so that's the government, the state level governments pulled in. And the way that we've handled COVID is that we're actually one of the very first countries to have some level of openness in our economy to start trading back again across the world. And so because of that, it has really helped our property market. It has really helped all of the other markets, really. Like Australian consumer confidence before COVID was actually below the positive sentiment of 100. It went up to over 100 after COVID. And so it really showed that the way we've handled things is what has created the confidence. And household budget have actually been in surplus for many because they've been saving. They didn't go on their holiday, they didn't eat out so much, they weren't going out so much. Some household budgets actually access the 20k extra from the super. And helping that with all of the other grants that is available to people in the property market, it has really helped that access to home ownership and really spur on more people to enter the market.
And Asti, that was quite a comprehensive explanation, and I think you are a true guru in that field, and that's no wonder why you are the chief economist, with PRD in that research division. And we talk to many people, but I don't think the way you have just put that and explained the situation. I think exactly to the point, and because often people wonder, that we have a minus migration. And there was all this doom and gloom. So what is actually driving? So all those factors that you've just talked about is the contributing factor. And you're quite right on that, the fiscal policy, and of course RBA working on to keeping that interest rate at the historical low, and of course working in with others. One of the points that you did mention, and putting on my other hat, looking at the agents, they are finding that people are getting access to finance to buy properties, to come into the market, but the approval process probably seems to be taking a little bit longer than what it used to be normally, even though the interest rates are quite low. And I think the financiers are a little bit cautious in the dealing, and quite rightfully too.
Yes, definitely. Correct on that, Umesh, because we are seeing a lot of people entering the market. However, there's a different process that the banks use. So for example, if you bought a house, or you're a first home buyer and you're about to build a house at a particular price point, say you've won an auction and you won a house at say $750,000. A lot of the times the bank use a valuation system that may not actually value the house at 750. They may actually value the house at 550 or at 650. And so that's where the discrepancy happens between the actual purchase price and the valuation process and the valuation methodologies that banks use. So that's one of the other reasons why settlements is taking quite long, because the banks are very, very cautious, knowing that, what is the actual true value of this house or this property versus the purchase price. There's that's number one. Number two, we are operating in a very low cash rate situation at the moment. Now, the banks do assess borrowers on a higher cash rate, on a higher mortgage home loan. So if the mortgage home loan at the moment is, say, on an average 1.98, banks actually look at your serviceability at a 3 or a 4% cash rate or a home loan rate. And that's what people get caught up, because they say, well, if it's 1.99, I can service this easily. But what they don't realize is that the banks actually evaluate them not on 1.99, because that 1.99 rate, it's not going to be there forever. And a house loan is 25, 30, 35 years. And so they always assess you at a higher rate. And, sometimes that's where people kind of get caught up, because they think that they might only have to pay 1,500, which is true if they fix that rate now for the next 3 years. But the bank is looking at, okay, if it goes up to 4% and you're going to have to pay $2,000 a month, are you still going to be able to service that after the next 3 years? And so that's the second point. And the third point is that sometimes the reason why is because the applicants don't have all of the paperwork. They don't have all of the pay slips. They don't have all of the everything that is needed. And the one thing that people don't realize, Umesh, you know those Afterpay, Zip Pay, you know, all of those things that a lot of people use right now? That's actually counted and really looked at in your mortgage application because the bank sees that as debt. If they see that you have a pattern of always being on Afterpay or Zip Pay on large sums of money, because you can go up to Afterpay now to about $4,000, $5,000. So if they see that you have a lot of Afterpay accounts or Zip Pay accounts and you it's not going down, or you're a repeat customer, so to speak, then you're telling the bank that you like getting into debt and that you're willing to get into a lot of different types of debt. And therefore, they take all of that into account, and that can actually lower your serviceability to a bank. And, you know, people don't know that.
Yeah. And quite rightfully said, because those things are liabilities. So even some of the accounts you might not be using, but if you've been pre-approved for, say, 20,000 on your card or something like that, but even though it's at zero, that reduces your borrowing capacity.
It definitely does, because the banks does not say, like you said, so if you've been approved, you have a $20,000 credit card and you have $1,000 on it. To the bank, you don't have a debt of 1,000, you have a debt of 20,000. And so whenever someone says to me that they're about to go for a mortgage loan, I always say to them, make sure you close your credit cards or pay them all off. If you have any Afterpay, Zip Pays, anything like that. Banks are also now very much looking at your lifestyle. So if they see that you're eating out a lot, or if you are doing a lot of Uber Eats or takeaways or taxis and all those sorts of things, you know, they see that as an expense. Many people don't realize this. They think that the expenses that the banks take into account is your rent, your gas bill, water bill, you know, things like that that are bills. But the banks actually look at your lifestyle as well. And so, yeah, sometimes it's always two ways. You know, sometimes you might have bought a property that's just actually a little bit too high and you've paid way above market price. Sometimes it's because you've had potentially bad credit history, and sometimes it's because you have other debts that you don't think that is a debt, but it turns out it's a debt.
And one of the points that I will make here in our conclusion is that you have mentioned about settlements taking a little bit longer. So the whole industry relies on quite a few people. And when I say quite a few people, so the investors, the buyers and the sellers, then of course we have the real estate agents, then we have the solicitors, put in place mortgage brokers, and mortgage brokers, then they are small mortgage brokers, then on top of them they have the people who actually underwrite. Then the valuers come into the account as well. Then there are settlement agents who actually attend to the settlements. And the paperwork that you mentioned, that is not always up to date. And I found that many times people, the paperwork and the paper trail that takes so much time. Now the whole settlement process depends upon the professional approach of all these people down the chain.
Oh, for sure. I work, I have a lot of mortgage broker friends and I have a lot of developer friends, For someone to sign an EOI for a developer, for them to say that, yes, I'm going to buy that new apartment, for example, it takes a long time to actually then go from an EOI, which is an expression of interest, to actually the settlement process. It's even longer if it's something that hasn't been built, in terms of the deposit and getting the loan and the finance and things like that. But when it is something that is an already stock that is ready, a lot of the times that can happen. I see it a lot where people are not aware of all of the things that they're supposed to put in. Having a mortgage broker, that's the part that helps. Or actually, what I would recommend is booking an appointment with, whichever bank that you are currently banking with. Even if you decide not to go with that bank, that home lending specialist of that bank will be able to give you a checklist of these are the things that you need to have. These are the things that you need to have, not only from a financial perspective, but also all of the documents that you have. I was speaking to a client the other day who didn't even know that he had to put his birth certificate as part of the application process, And so it's those things that could be eliminated if you engage in a professional and if you actually even have that whole checklist.
Well, once again, Asti, thank you very much for that. It's such a pleasure, presenting the show with you. And because, the expertise and the knowledge that you have, it just flows through. Okay, so, in conclusion, would you like to, get the results of the suburbs?
Oh, I'm so excited about this.
Yes.
I am so excited about this, Sumesh. Okay, for everyone who is listening, this is the part that you take notes. This is the part that you take notes of all of the suburbs. So for those of you who are interested in buying a house in Brisbane, these are the top 3 affordable and livable suburbs that you can choose from or that you can have a look into. So the first suburb is Ferny Grove, which is kind of north. Ferny Grove. The second is Rochdale South. And the third is Springwood. So that's for houses. So the median price in Ferny Grove at the moment is 653, Rochdale South 545,000, and Springwood 630. Now, for units, if you're looking at units, you want to have a look at Coorparoo, Tigum, and Warner. Warner is probably the least expensive, median price of $290. So, I'll repeat that again. It's Ferny Grove, Rochdale South, Springwood, and Coorparoo, Tigum, and Warner. So that's for Brisbane. If anyone would like the others, feel free to contact me. But the one thing that I will say is this, Umesh. In Sydney, because we do this for all of the capital cities, yes, right? So for Sydney, the most affordable and livable suburb is actually in Peakhurst, where the median price is 1.2 mil. Whereas for us here in Brisbane, the highest median price is Ferny Grove at 650. So you see the differences in terms of the capital cities, right? And the same thing when it comes to units as well. So one of the key findings that we've had, which is great news for Brisbane, is that Brisbane is the capital city that gives the most bang for buck for 3 years running. And what that means is that the median prices in Brisbane is half of Sydney, but the rental yield is double. So in Peakhurst, if you want to enter Peakhurst, you need to spend $1.2 million, but the rental yield is 2.4%. Here, you spend in Brisbane, you spend $650, and the rental yield is 4.4. So it's more bang for buck because the entry price is lower and the rental yield is higher. And I always have mixed feelings saying this to people because everyone believes that Hobart is the most affordable capital city. They're starting to not be. So the most affordable and livable suburbs that we were able to find in Hobart actually had the same median price as Brisbane for the housing market. And for the unit markets, the affordable and livable suburbs in Hobart actually has a higher price than Brisbane. So, beforehand, Hobart has always been known as the most affordable market. Now it's kind of neck to neck a little bit over Brisbane, a little bit, and that we're becoming more of that affordable capital city. And everyone always asks me why, right? What's happening with prices? And it all comes down to demand and supply. The government in Hobart, when it comes to their residential construction planning, is not as advanced as Brisbane. And so, we looked at how many houses is coming to Hobart in the next 6 months, and only 50 houses are coming. Compared to Brisbane, where there's 300 odd houses coming. There's about 3,000 units coming in Brisbane, and only about 150 units in Hobart. So it's always that play in demand and supply.
And quite rightfully said, it is about demand and supply. And even the prices are dependent on that. You could put whatever price on whatever property. In the end of the day, it's only worth what someone is prepared to say. So Asti, all those reports and the other reports that you put out, if people want to get a hold of the hard copies or a digital copy, where do they go? How do they get access to that report?
Very easy. All of the reports are available online. It's free to download, so you don't have to pay anything. I think the only thing we ask is for you to enter your email address, so we know that you're not a robot. But it's prd.com.au //research hub. So even if you don't get that / bit, if you just get prd.com.au, you will definitely be able to access all of those reports. It's on our social media as well. So if you search on Facebook or Instagram or Twitter or LinkedIn for PRD Real Estate, it will come up, and all the links are there on our social media as well. And one of the things that I've always believed in when it comes to research and information is that something as crucial as this that can assist in people in decision making should be free, because at the end of the day, information is power, and we want to help people to be able to get into the market and make the best decision possible.
Wow, it is wonderful that research and that report is free. So ladies and gentlemen, that's that web address, and if you log on, you can download the reports, and if you can see from the presentation today and the discussion that we've had, that Asti has a wealth of knowledge, and of course all those things combined are put in the report. So if you are in the market or whatever, it will give you quite an insight and into the report. So you could just, if you just went by prices, you could just go by prices, but all the other research has been done. So the hard work's been done, it is there, and as we know, being in the industry there from over the years, everyone knows and relies on PRD's market research, and of course all the reports that have been put out for over the years. It's been the long-standing trusted source of information for anyone in that industry. So once again, Asti, thank you so much for being on the show. So is there anything you'd like to say in conclusion to all our viewers and listeners?
Thank you so much, everyone, for tuning in, and also Umesh for having me. It's always been a pleasure. Look, the last thing that I would say to anyone when it comes to the property market is that obviously property markets and your decision is very much so personalized to you, to your financial situation. The suburbs that we've put forward in this particular report ticks all of the boxes that we believe are important if you are going to buy a house or invest or what have you. However, it does depend on your own personal circumstance. Some people are happy to sacrifice the investment stuff because they know that they're going to be living there for a long time. Some people are happy to sacrifice other things so that they can get a much cheaper house. But my conclusion and my advice to everyone is always, I know that at the moment there's this FOMO, fear of missing out, from properties that are being on the market and things like that, particularly in suburbs that you like. One, always do your research. And when I say research, there's more to it than just looking up on realestate.com.au about all of the other all of the other properties that are available. If you read this report, it actually gives you a pretty good methodology checklist that you might want to apply to your own decision making. So that can really help you in that manner. And the second one is, one of the reasons that we put this report is to open up people's eyes and people's ideas on where to live. A lot of the times people come to me and say, oh, I can't find properties, I can't find houses, there's nothing. And I said, well, where are you looking? And they're only looking at 2 suburbs in Brisbane, for example, you know. And so one of the things that I always say is consider all of the options. This particular report opens up your eyes to other suburbs that is, you know, has already been researched, and that little bit of flexibility, moving 2 suburbs away from your ideal suburb, could actually save you $50,000, for example. So those would be my closing comments.
And once again, very well said and very well put. Thank you very much for your time and all that information that you have said. It's wonderful, always, you know, and it's always a pleasure doing these reports with you.
Thank you so much, Umesh.
Until next time, please remain safe and have a wonderful day.